Hello, and welcome to the September IASB Update podcast. I am Neely Shah, the Executive Technical Director at the IASB, and today I'm joined by the Vice Chair of the IASB, Linda Mizan-Hutter. Welcome,
Hey,
Linda.
Neely. Glad to be here.
Thank you. This month, our fearless leader, Andres Barco, is unable to join us due to other engagements. Linda, I think that means we can have some fun with this call, right?
Absolutely.
All right. So as always, we will share with you the key highlights from our September IASB meeting. Let's start with the Business Combinations Disclosure, Goodwill and Impairment Project, or BCDGI, as some of us like to call it. This month, the board reached a major milestone in the project. Linda, would you like to tell us a bit more about the decisions?
I would, Neely. In this meeting, we completed our technical discussions on the BCDGI project by making decisions on which of the disclosure proposals in this project should be reduced for subsidiaries without public accountability. We also decided on transition requirements for the proposed amendments. Having completed the technical discussions on the project, the board gave a green light to the project team to begin the balloting process for the exposure draft. We expect to issue the exposure draft in the first half of 2024 with a comment period of 120 days. So please watch this space.
Thanks, Linda. Another standard-setting project that the board discussed this month was the Rate-Regulated Activities project. This project is progressing towards a final standard, and the board decided to include a new concept in that standard. Linda, can you elaborate on that decision?
Sure, Neely, with pleasure. If you followed this project closely, you might have noticed that through a redeliberation of the proposals in the exposure draft, we've identified a concept that is absolutely fundamental for the application of the rate-regulated activities model. It's called the no direct relationship concept, which considers the extent to which a company's regulatory capital base and its property, plant, and equipment are similar for the purposes of identifying differences in timing. The staff has tested this new concept with several stakeholders through a survey and other outreach, and we very much appreciate the feedback from those who participated. The feedback we received provided evidence that the no direct relationship concept will help companies to identify differences in timing arising from the compensation they receive on their regulatory capital base.
Thanks, Linda. The board also deliberated and made decisions on the measurement proposals in the exposure draft, dealing with credit and other risks affecting the estimates of future cash flows arising from a regulatory asset or a regulatory liability. And our listeners can have a look at the details of those decisions made on the September IASB update, which is on our website. So now let's move on to the equity method project. I'll start by reminding our listeners that the objective of this project is to develop answers to application questions about the equity method. The IASB started this project by developing answers to the application questions for investments in associates. Now, the IASB is considering any implications to other investments accounted for by using the equity method. Linda, could you provide some highlights of the key takeaways from the discussion this month?
Sure can, Neely. This month, we discussed the implications of applying the IASB's tentative decisions on the equity method project to date to investments in subsidiaries in separate financial statements and also investments in joint ventures. We did not make any decisions, but the staff will continue exploring the implications and prepare decision-making papers which will be discussed at a future meeting. We decided to propose amendments to IFRS 12, Disclosure of Interests in Other Entities, to help investors evaluate the changes in the amounts in the financial statements arising from investments in associates. You can see the specific proposed requirements in the papers of the meeting and in the IASB update on our website. Finally, we discussed whether to expand the scope of the equity method project for 3 application questions, and the board decided to retain the existing project scope. The board will continue its deliberations as it progresses towards publication of an exposure draft in the second half of 2024.
Thanks, Linda. Another project the board discussed this month was the second comprehensive review of the IFRS for SMEs Accounting Standard, The board discussed the project plan and other overarching topics, which will assist the IASB in its redeliberations of the proposals. Linda, would you like to tell us more about the decisions that were made?
Absolutely. The IASB confirmed it will provide educational materials to support the updated IFRS for SMEs standard once it's finalized. We also discussed the findings from the fieldwork with practitioners on the revenue proposals. The proposals were identified as a significant area of change for SMEs, so we undertook fieldwork to understand how the proposals are likely to affect SMEs, with a focus on the judgments that an SME would be required to make when applying the revenue proposals. And to those of you who participated in the fieldwork, a big thank you for your time and input. Finally, we discussed the feedback in the proposals in the exposure draft on introducing an expected credit loss model into the standard. The board was actually divided on how to address this feedback. Therefore, the staff will do further research on possible approaches for discussion at future meetings.
Thanks, Linda. So in September, the board also discussed high-level feedback to its exposure draft, proposing amendments to the classification and measurement of financial instruments. And just as a reminder to our listeners, the IASB published the exposure draft for this project in March 2023, and the comment period closed in July. In September, the board noted that many respondents supported its proposals overall, but had some recommendations that the board will discuss at future meetings. Now let's move on to some of our research projects, and we'll start with business combinations under common control, or BCUCC for short. Linda, could you provide an update on that discussion?
Sure, I'd be happy to do that, Neely. If you have followed this project closely, you might recall that in April this year, the board reached a reflection point and started considering the project direction of BCUCC. We discussed 3 possible options, the first one being to develop recognition, measurement, and disclosure requirements, the second one being to develop disclosure-only requirements, and the third one being to discontinue the project. The staff collected feedback on these options from public meetings with consultative groups and meetings with other stakeholders. This month, the board discussed the feedback and the staff analysis of that feedback. Stakeholders provided us with a lot of valuable feedback to consider. We discussed the advantages and disadvantages of each option at this meeting and expect to make a decision on the project direction in the next couple of months.
Thanks, Linda. So this month, the board also discussed another research project, this time on the direction of the Extractive Activities project. Can I come back to you to tell us a little bit more about the decisions made?
100%. As some of you might recall from our July meeting, the IASB had been discussing the feedback on possible ways to improve disclosure requirements related to exploration and evaluation expenditure and activities. In the September meeting, the board considered that this feedback evidenced no strong demand or urgent need for standard setting, and consequently, the board decided not to develop additional disclosure requirements or guidance. As a result of this decision and past decisions in the project, the IASB decided to actually stop work on this project. In addition, the board confirmed the work performed in this project concludes the comprehensive review of accounting for extractive activities envisioned by the IASB when issuing IFRS 6, Exploration for and Evaluation of Mineral Resources. Although the IASB decided not to undertake standard setting in this project, this has been an important piece of work, and the board thanks our stakeholders for their contributions to this work.
Thank you, Linda. We will publish a project summary on the Extractive Activities project, so keep an eye out on our website. So now let's move on to the project on climate-related risks in the financial statements. As a bit of background, the IASB started this project in March in response to feedback on its third agenda consultation. In that consultation, our stakeholders expressed concerns that the information about climate-related risks in the financial statements is insufficient and inconsistent with information in other reports. Since March, the staff has been conducting outreach and research to learn more about the nature and causes of stakeholder concerns about the reporting on climate-related risks in the financial statements. And I stress financial statements because the scope of the IASB's work is focused only on those items that belong in the financial statements. That is, those that meet the definition of assets and liabilities and disclosures related to them. In conducting this work, we are fortunate to have the support of our colleagues from the ISSB, our sister board, to provide us with technical input on climate-related matters and to ensure that our work and that of the ISSBs are connected. So, in September, the staff came back to the board to discuss the staff's findings from its research and outreach and possible next steps. Linda, can you share more about that discussion?
Sure, Neely, I'm happy to do that. And as I'm sure our listeners are aware, climate-related risk is very topical today, and given developments around the world. So I can attest that the board's discussion was quite robust. The board noted one of the main takeaways from feedback is that the requirements in IFRS accounting standards are generally sufficient, but there are challenges in application. Another key takeaway is that our stakeholders are seeking assistance as soon as possible. So, to help improve application, the board decided to explore the development of a package of practical examples to operationalize the principles and requirements in our accounting standards. This is something that can typically be done faster than standard setting. At the same time, the board also decided to explore possible targeted amendments to improve disclosures about estimates in the financial statements. Of course, the development of estimates is an area that requires significant judgment. So the staff will need to do some more work to assess whether standard setting can really help in this area and whether the benefits of standard setting outweigh the risks of unintended consequences. And finally, because our accounting standards are principles-based, if we were to do any targeted standard setting, it wouldn't single out climate, but would cover other uncertainties generally. Otherwise, we would need to constantly update our standards as uncertainties emerge in our ever-changing world. So the board also decided to generalize the objective of the project to now cover climate-related and other uncertainties in the financial statements.
Thanks, Linda. And just to add, in the discussion, several board members observed the pace of change in this area, particularly given reporting developments from the work of our sister board, the ISSB, and others in this space. So we will continue to monitor and explore ways to assist. And we have consolidated all of our work on climate-related and other uncertainties in the financial statements onto a single web page to help stakeholders find articles, educational materials, and other developments more easily.
Thanks, Neely. And to finish off our discussions, we discussed an update on the progress of the IASB's work plan. In particular, we noted that as a next step on the management commentary project, the IASB will discuss with the ISSB the feedback from the ISSB's consultation on agenda priorities published in May this year. This consultation includes questions about a potential project on integration and reporting, which could be done jointly with the IASB and could build on the management commentary exposure draft. This joint discussion with the IASB and ISSB is aimed to help the IASB decide the future direction of the management commentary project sometime in the first half of 2024.
Thank you, Linda. So that concludes our September discussions and this month's podcast. You can catch up on previous episodes of this and the Interpretations Committee podcast on our website, as well as on our YouTube channel and Spotify. For the latest developments, make sure to subscribe to our website. And if you like this podcast, please do take some time to rate, review, and subscribe on your preferred podcast player. Thank you very much for joining us, and please tune in again in October for an update on the October IASB meeting. Thank you.